Well, for a bit more on that and what other news from today means for debt capital markets, we're joined now by Stephen Nash from FIIG Securities in Sydney. Stephen, thanks for joining us. Is this news on a legislative deal on bank supervision by 2012 for the EU at least being seen as a positive first step?
I think broadly the deal is a positive for markets, but I think there's a lot of other stages that have to be gone through, particularly with regard to the funding of recapitalisation of the banks in countries that have not agreed to conditions for bailout. I think Germany's continuing to be concerned that there could be a bypass of the conditions by banks, say Spanish banks for example, accessing bailout funds without Spain having agreed to other conditions. So I think that's got to be sorted out, and that's what the market will be looking for going forward. And I think that's a bit of a positive broadly.
Yeah, you mentioned Spain, but then there's also Greece. Tomorrow, Saturday, marking the 3rd anniversary of the day Greece revealed its deficit was actually 4 times the limit set for countries using the euro. But even after what we've seen is billions in budget cuts and an EU IMF bailout, the situation's still pretty dire there. So I guess there's still further steps that need to be taken towards sorting Greece out as well. Look,
I think broadly we're getting towards the end of the first stage of the European crisis, and this has really been dominated by the idea that budgets have to be brought under control. I think the next stage will be one more focused on growth. There was some discussion yesterday about the Germans looking at a possible infrastructure fund for countries that agree to conditions for bailouts. I think that is a really positive indication, and hopefully we can get into the second stage and get some infrastructure projects up and running with some employment implications from that. Otherwise, if we continue to focus on austerity, the growth trajectory for Europe is not very positive at all.
No. All right, looking a bit closer to home then, Stephen, we saw yesterday China's third quarter GDP growth coming in at 7.4%, meeting expectations broadly, and some other data out of their retail sales, etc., really showing some signs of stabilisation for China. What does this all mean now for near-term RBA interest rate easing expectations?
Look, I think the RBA has seen a moderation in Chinese growth. I think they'd be happy to see a stabilisation in that growth. I don't think a stabilisation of Chinese growth will take off any possibility of an easing at this point. We do have the CPI coming up next week. There's quite a wide range of forecasts in terms of headline CPI, mainly because of expectations and differences in opinion about the pass-through from the carbon price. We've got a range of something like 0.8 to 1.4 in terms of the headline CPI read next Wednesday. So it's a very wide range, and I think that's going to be very important for the RBA. However, they'll be focusing on the core rates.
Okay. And yesterday we also saw some interesting comments from Bank of Queensland when it came out with that loss, but also Stockland coming out and with a bit of a surprise to the market, saying, or Matthew Quinn at least, CEO, saying that it is the worst housing market conditions in 20 years. So both continue to be very cautious on the prospects for the property market. Does this underline the difficulties that the RBA is facing in terms of stimulating this sector?
Yeah, well, there was a speech recently by Lowe that emphasised that they're expecting the gains we've seen in the mining sector in terms of employment to moderate substantially going forward, and that the construction sector really has to take up some of that slack. I think some of these rate cuts are directed at stimulating that sector. Hopefully that will be the case. As we get rates approaching or going under the inflation rate, it might stimulate some more interest in the property sector broadly. Hopefully the banking sector can ease some of the credit restrictions that they're currently placing on particularly developers, and that might also get the construction sector going a little bit further going forward. But yes, these comments just indicate the difficulties out there. These are people that are on the ground seeing what's going on day in, day out, and they're seeing a very tough environment, but they're seeing some cause for optimism. It's just a little bit early to get too built up about that.
Dr. Stephen Nash from FIIG Securities in Sydney, really appreciate your analysis. Thank you.
Thanks very much.